Nucor has been on an incredible 9-week price rally. Now, this isn't just a number on a chart. It's a sustained push that's signaling a major structural shift in the entire North American steel market. So let's break down what's happening and, more importantly, why it matters to you. Let's start with the big number. By late December of 2025, Nucor's hot-rolled coil price hit $950 per ton. Now, that is the highest we've seen since all the way back in early May, and it really sets the stage for everything we're about to talk about. And look, this isn't some brief one-off spike. We are talking about a consistent 9-week rally that's more than 2 months of uninterrupted increases, adding about $90 per ton to the base price. Momentum like this is pretty rare, and it tells you that something much deeper is going on in the market. Okay, so let's get into it. We're going to examine what is really driving these prices and what it signals about the broader market, especially when you factor in some key policy decisions. You know, a rally like this doesn't just happen in a vacuum. It's really being propelled by two main drivers: a major policy shift on the supply side that's working together with some remarkable strength on the demand side. And here are the two big ones. You've got these two forces working in perfect tandem. On one hand, you have the reshaped trade policy of the Section 232 tariffs, which is seriously limiting foreign competition. And on the other, you've got this robust domestic spending, especially in infrastructure, that's creating very durable, long-lasting demand. The single most significant factor here is probably the dramatic expansion of those Section 232 tariffs. Doubling them all the way to 50% back in June 2025 just fundamentally altered the competitive landscape. It's effectively created a protective moat around North American steelmakers. Think about what 50% really means. A 50% tariff isn't just a tax, it is a total game changer. It forces anyone importing steel to completely recalculate their costs, making domestic steel the most viable and sometimes the only option for many buyers. But here's the thing, tariffs alone don't sustain a rally. You need customers who are willing and able to pay those higher prices. And that's exactly where the other driver comes in. The construction sector is providing that powerful long-term support, that essential pull-through mechanism that justifies these repeated increases. And the scale of this demand is, well, it's just immense. As of August 2025, U.S. construction spending hit an annualized rate of $2.17 trillion. That is a massive indicator of huge steel consumption. Now, if we break that down, you can see where the real power is. Sure, non-residential and institutional sectors are growing, but look at infrastructure. That's the key driver here, projected to expand at nearly 8% annually all the way through 2030, thanks in large part to major federal programs. This is a really crucial piece of the puzzle. This isn't just a Nucor story. What we're seeing has become a truly market-wide movement. This quote really hits the nail on the head. When you see multiple major producers all moving in the same direction on pricing, it sends a powerful signal. It tells you that the big picture drivers, like tariffs and demand, are so strong that they're overpowering any single company's individual strategy. It validates the entire market's underlying strength. And the evidence is right here. It's clear across the industry. While Nucor was hitting that $950 mark in December, you had Cleveland-Cliffs raising prices by $75 a ton back in May, and NLMK USA putting through 2 separate $50 hikes in the fall. This is a very clear sign of industry-wide pricing discipline. So, the current picture is obviously strong. But a complete analysis means we have to look ahead. We need to balance the potential risks, the headwinds, against the long-term structural opportunities, the tailwinds, that are on the horizon. On one side, you have potential headwinds like end users getting cautious about their inventory levels, the constant pressure of global oversupply, and, of course, uncertainty around tariff policy. But balancing those out are some really powerful tailwinds: that durable infrastructure demand we just talked about, stable automotive production, and a very significant trend called nearshoring. Let's focus on this nearshoring effect for just a second because it is absolutely critical and maybe a little underappreciated. As more and more companies relocate their manufacturing back to North America to build more resilient supply chains, it creates a whole new, durable base of demand for steel, one that's much less dependent on those short-term business cycles. So, when you put all of these pieces together, what's the key takeaway? What are all these signals really telling us? Well, it all points to a significant, maybe even a permanent, shift in the market's fundamental structure. What we're witnessing here isn't just a temporary peak in a normal business cycle. Nucor's rally reflects a genuine realignment of the steel market, one that's being powerfully driven by a convergence of policy, sustained demand, and a whole new level of producer discipline. You could say the rules of the game for North American steel have truly changed. So, for you professionals in the industry, what does this all mean? First, the market strength is real, and it's backed by strong fundamentals. Second, that producer discipline we talked about is holding firm. Third, you've got to stay vigilant about political and macroeconomic risks. And all of that points to a balanced inventory strategy as being the most prudent path forward right now. And that leaves us with a critical question that everyone should be considering as we head into the new year. Is this level of pricing power, this producer strength, the steel market's new normal? It's a question that is absolutely going to shape strategy investment across the entire industry.